where we will explore how the world of currency trading is kept safe and organized in India. As our world becomes more connected through globalization and the easing of rules for cross-border money flows, we see more money moving in and out of the country. This can lead to imbalances and make the value of currencies jump around quite a bit. Because of this, both people living in India and those staying abroad face currency risk, which means they could see a profit or a loss simply because the exchange rate changed between the time they bought an asset and when they sold it. To help manage these unpredictable movements, everyone is encouraged to participate in exchange traded currency derivatives or ETCD. This entire system is guided by a strong regulatory framework, including the Foreign Exchange Management Act of 1999, the FEMA regulations from the year 2000, the RBI Master Directions from 2008 and 2010, and specific circulars from SEBI that set the rules for who can trade and how much they can trade. Now that we have the background, let's look at a key group of players in this market, which are the big banks, known as Authorized Dealer Category 1 banks. To act as trading and clearing members for their own accounts or for their clients, these banks must follow strict health checks. They are required to have a minimum net worth of 500 crore rupees and maintain a capital to risk weighted assets ratio or CRAR of at least 10%. Furthermore, their bad loans, known as net NPA, cannot be more than 3%, and they must have shown a net profit for the last 3 years. If a bank does not meet these rules, or if they are urban or state cooperative banks, they can only join as clients and need special approval from the RBI. These banks also have to stay within operation limits like the net open position and aggregate gap limits, and they can sometimes balance their ETCD trades against other types of derivatives. Building on that idea, let's talk about the rules. For regular people living in India, if you are a resident, you can take a position in the market. Whether you are betting, the price will go up or down without having to prove you have a specific business need for it, as long as the total is not more than 100 million USD equivalent across all exchanges. However, if you want to trade more than 100 million USD, there is a process to follow. You must pick a designated authorized dealer or custodian, and the exchanges will report your daily ending positions and your highest positions during the day to them. Just remember, it is your responsibility to follow these rules, or you could face legal action under FEMA 1999. Just like residents, foreign investors have their own set of guidelines to follow in this video. Foreign portfolio investors or FPIs can also take positions up to 100 million USD equivalent across all currency pairs involving the INR without showing proof of underlying exposure. But there is a very strict rule for them. Their short positions across all stock exchanges for contracts involving the Indian rupee must not go over 100 million USD. To keep things transparent, exchanges must provide the daily and intraday position data of these FPAs to their designated custodians. Like everyone else, the FPI is responsible for following the rules and is liable under FEMA 1999 for any mistakes. Next, we have the rules for non-banking financial institutions, often called NBFCs. These institutions usually follow two specific paths. Under Path A, certain NBFCs can participate in currency futures on recognized exchanges, but they can only do so as clients and only to protect themselves against real foreign exchange risks. Path B is for those NBFCs that do not take deposits and have a large asset size of 500 crore rupees or more. These institutions are allowed to trade in currency options as well, but the same rules apply. They must be clients and use these tools only for hedging their actual business risks according to RBI guidelines. Moving forward, let's turn our attention to another important group known as primary dealers. To be eligible, a standalone primary dealer or SPD must have a minimum net own fund of 250 crore rupees. They are allowed to be clients or even direct trading and clearing members on the stock exchanges. However, there is a big restriction. They can only trade for their own account and are not allowed to take positions for other clients. There are also specific limits on how much they can trade in different currency pairs. For the USD and INR pair, they cannot exceed 15% of the total interest or 50 million USD, whichever is higher. For pairs involving the euro or the British pound, the limit is 25 million, and for the Japanese yen, it is 1000 million. It is also important to understand how the central bank keeps the market stable for everyone. The RBI steps into the currency derivatives market whenever it is necessary to stop wild price swings and keep things running smoothly. They do this for both the OTC and the ETCD segments, and they publish data about these actions in their monthly bulletin. In a very important update, from January 5th, 2024, the RBI clarified a key rule. While users can take positions up to 100 million USD without showing paperwork upfront, they must actually have a valid real-world need to protect themselves against currency risk. The RBI wants to make sure that everyone using these derivatives has a genuine reason for doing so. Now that we understand who can participate, let's look at what it takes to actually become a member of the exchange. The membership for currency derivatives is kept separate from other parts of the exchange and is governed by SEBI regulations from 1995. In the past, you needed different registrations for every exchange, but that rule has been removed. Now, there is a single registration framework where SEBI issues one certificate that covers all exchanges and segments, while your net worth is looked at collectively across all your business. The deposit you maintain must be calculated separately for each segment. If you want to start trading on a new exchange, you just need their approval rather than a whole new registration from SEBI. But a big part of this membership process is something called base minimum capital or BMC. This is a deposit you give to the exchange that acts as a safety net for emergencies, and you cannot use it to take on more trading positions. The amount you need to deposit depends on what kind of trading you do. For example, if you only trade for yourself without using computer algorithms, the deposit is 10 lakh rupees. If you only trade for clients, it is 15 lakh rupees. If you do both, it goes up to 25 lakh rupees. However, if a broker uses any kind of algorithmic trading, the deposit is 50 lakh rupees. It is also a rule that at least 50% of this deposit must be in the form of cash or similar liquid assets. Now let's look at the personal requirements for individuals and partnership firms who want to join. If you are applying as an individual, you must be an Indian citizen, at least 21 years old, and have at least a high school education or equivalent. You also need to show that you have at least 2 years of experience working with a member of an exchange. For partnership firms registered under the Act of 1932, the firm must name at least 2 partners who will handle the daily management. These partners must also be 21 years old, have a high school education, and possess 2 years of relevant experience in finance or securities. The firm must also identify a dominant promoter group, and any changes in ownership require permission from the exchange or SEBI. Building on that, we have specific rules for companies and limited liability partnerships. A limited liability partnership or LLP formed under the Act of 2008 must follow the financial rules set by SEBI. They need at least 2 designated partners who meet the age, education, and experience requirements and have never been part of a firm that defaulted or was expelled. For corporate entities or companies, they must have a minimum paid up equity capital of 30 lakh rupees. They also need at least 2 designated directors who are at least 21 years old and have the necessary education and experience. Just like partnerships, they must identify their dominant promoter group to the exchange. Banks also have their own specific checklist to become trading and clearing members. As we mentioned earlier in this video, banks that are authorized by the RBI must follow a prudential checklist. This includes having a minimum net worth of 500 crore rupees and a CRAR of 10%. Their net bad loans or NPA must not be higher than 3%, and they must have a record of making a net profit for the last 3 years. These rules ensure that only strong and stable banks are handling these important financial trades. It is just as important to know who is not allowed to become a member of the exchange. An entity or person cannot join if they have been declared bankrupt or insolvent. Even if they have cleared their debts later, you are also disqualified. If you have been convicted of a crime involving fraud or dishonesty, other reasons for being rejected include being kicked out or declared a defaulter by any other stock exchange, or being banned from trading by SEBI or the RBI. Finally, if the exchange feels that letting someone join would not be in the public interest, they have the power to deny the application beyond just the numbers and legal history. SEBI also looks at the character of the applicant through the fit and proper person test. This means they evaluate your integrity and your overall character. They check to make sure you have no past convictions or orders against you and that you have never been labeled as a willful defaulter. You must also show that you have the competence and financial strength to do the job. In addition to this, you must have the right infrastructure like a proper office and the necessary computer systems to serve investors and follow the exchange standards. Finally, let's talk about the role of an authorized person. An authorized person is not a member of the exchange themselves, but they act as an agent for a trading member to help people access the trading platform. A trading member must get specific approval from the exchange before appointing any authorized person, and this approval is only for one specific segment. To be successful, an authorized person must have the right setup to do their work, which includes having adequate office space, the necessary equipment and workstations, and enough staff to handle the activities of the stockbroker effectively.